Hi, I'm George Nordhaus, and welcome to Monday Morning. We're going to talk about a subject near and dear to every agency owner's heart, I think, agency valuation. How do you really value an agency? And, we've all kind of lived with that for many, many years. We thought we knew where we were going, but how do we do it and why do we do it? And are we doing it the right way? And when I had talked to Al Diamond, who's president of the Agency Consulting Group, we were talking about this, and he said, "Hey, maybe people not maybe he already knew that people should consider something a little bit different." First of all, let me introduce you to Al. Al Diamond has been around for a long, long time, 4 decades. How's that? And he and I have been working together for 4 decades, as a matter of fact, as you can see. And he's the editor of the Pipeline, and I love the Pipeline, and I try to encourage all of you to get the Pipeline. As a matter of fact, I'll do that again at any time you want me to, Al. We'll send out a note to them because, well, I tell you what, let's do, Al. When we get to the end of it, let's have a place where they can link on in and get the Pipeline. It's a great monthly newsletter, but it goes right to the heart of us, how we run our agencies. Agency Consulting Group is in New Jersey, but they're all around the country. Al's gone half the time, or more than half the time. He's on the phone with agencies time and time again. Uh, he's spoken for me on many, and he does speak on a lot of occasions. So I guess, Al, have I missed anything that I should be saying?
Oh no, George, you uh, make me look a lot better than I am, and that's exactly what I'm looking for. So everything's good.
I don't believe it. All right, what's the order of events today?
All right. Well, one of the things that everyone asks on a continuous basis is why bother with evaluation at all? Everybody's busy running their agencies. Then the next question is always, how much is my agency worth, or someone else's agency? And can I do it myself, or do I have to have a specialist? Because as I'll contend in a few minutes, the methods that we use are the same methods that the agent can use themselves. And then we're going to talk about valuation voodoo. It's the thing that costs you a lot of money when consultants and valuers try to express valuations in forms that are really too complex. Uh, and we compare it against the true value of an insurance agency, which is how much money is it going to make over a certain period of time.
Let me
And we'll cover all of these in the next few minutes for anyone who wants to hear it.
That's good. Let me ask a question. Do agents in general, because you're working with them on a one-on-one basis, do they evaluate their agency on an annual basis?
They should. You never know when something will happen, and trying to do evaluation after the fact is more costly and time-consuming and delays things that must happen in the event of an emergency or a tragedy.
Right, I got it.
So let's start with the question, why bother with evaluation of your insurance agency? Everybody is out there selling insurance, servicing accounts, trying to deal with the insurance companies on a daily basis, and valuation is sometimes the last thing on our minds. But what we remind every agent is that you got to practice what you preach. You are out there selling protection of people's assets as part of your practice as an insurance agency. Yet most of us don't protect our own assets adequately. And the main asset for many insurance agencies is the value of their insurance business itself. So you got to protect your own assets. In order to do that, you have to know how much it's worth. Estate planning is not something that happens for old codgers, George, like you and me. Estate planning is necessary for that 30-year-old who challenges the highway by crossing the street every day to go to and from lunch. You never know when something bad can happen to you, and you don't have to be in your 60s, 70s, and 80s for that to happen. So you need to do estate planning today, whether you're 35 years old or 65 years old, and a part of that is identifying the value of each of your assets.
Good.
Perpetuation planning is a key element now in every agency that I know of. As you know, George, we just finished doing 50 seminars around the country on perpetuation planning, and they were very well received, and we have a lot of perpetuation plans going on. A part of that is not only identifying who will be your successor or the merger candidate or the acquisition candidate, but how much can you get for this, and when is the time that you can turn the reins over to someone else? In order to do that, you have to have a valuation.
Mm-hmm.
Many of us who have partners or should have partners need to have buy-in and buyout potentials, which require us to know the value of our agencies on a per-share basis, either every year or every 2 or 3 years. It doesn't have to be every year, but it needs to be done on a regular basis, especially if you have partners in place. And know what it's worth when someone makes you an offer. A lot of agencies out there from small to medium and large find themselves targets. We have conglomerators and we have large organizations that have 10, 15 people hired to go to agencies and make them offers and entice them to join their organization or to sell to their organization. When someone makes you an offer, wouldn't it be nice if you knew how much your agency was worth?
It would, yeah.
So, with that in mind, let's start with the major question of the month. How much is my agency worth? Any agency. And our contention is that an insurance business is worth at most what you or someone else can earn by operating that business over a reasonable period of time. And that's the definition of value. However, there's a difference between value and fair market value. The fair market value is an agreed upon price between a willing buyer and a willing seller that causes a change of ownership. Now, that could be above the value in some cases or below the value, but you need that marker, that valuation of the agency to begin that process. And then there's price, which also differs from value, because a price is negotiated between a buyer and seller and takes into account abnormal risks and returns that the buyer or the seller would have that could either discount the value of an agency or enhance the value of an agency. We've seen prices of agencies 150% of the value, and it's wonderful when that happens. We've also seen some unusual cases where the price of an agency was well below its value because the value to that buyer was different than the value to the agency owner. So now we have value, we have fair market value, and we have price. You've heard this, and if you've bought or sold agencies, you know that there are two primary ways of buying an agency, either a stock sale, which is buying the corporation, or an asset sale. There is no right or wrong. It depends on the situation. A stock sale buys the corporation. It is appropriate in internal perpetuation, used to be very often, now only sometimes. And it's not appropriate in most acquisitions. It may be right for a merger. If you've heard the name bantered about, it's called a tax-free exchange, where you have two agencies that can come together, bring their agencies together, increasing the value of both, and not having a taxable event when that happens. That can be done in a corporate merger. Stock sale buys the liabilities as well as the assets, and that's why there are so many acquisitions that are made of assets instead of as stock. We leave the corporation in the hands of the original owner along with the liabilities because the new owner doesn't want to take on those liabilities. So that's the difference between stock and asset sales. Now, the question that we have asked, sometimes silently and sometimes very vocally, is do I have to use a specialist or can I do it myself? And the answer is, can you do it yourself? Absolutely, you can do it yourself. Here are the qualifications. You have to know your financials inside out. You have to be good at accounting in order to do this and be fairly good at spreadsheeting. We actually sell a home version of our valuation that somebody can buy for like $500. And then they can do their own valuation, and they can do reiterations or valuations of other agencies using this software. But I warn you, it's not for the meek, and it's not for the great salesperson and the technically competent insurance agent who hands all of his accounting over to his bookkeeper or his CPA. This is for the financial managers among us who understand balance sheets and operating statements. So the second question is, should you do it yourself? And the answer is probably not. Unless you know a good surgeon who has operated on himself recently, that in itself is why you shouldn't do it yourself. You're not objective about your own operation. You're subjective. You want a third party, you want an outside person looking at it. Should you understand how the valuation is done? And in our opinion, that's an absolute yes. Valuations should not be a mystery. It should not be a crystal ball. It shouldn't be a 500-page report where you only look at the first page to see how much it is. You should know how that valuation is done. If you ever get a valuation that's a one-page document that says your agency is worth 2.5 times, unless he's charging you $50, you send it back and ask for your money back.
Okay.
So, the Revenue Ruling 5960 is the genesis of all business valuations. And there are several things, there are 8 factors that are considered in evaluations of a business. I want to cover them briefly. I know this is going to be a little onerous, but listen to the 8 factors. Everything that a valuer does, an appraiser does, has to fit within these 8. Number 1 is the nature of the business and the history of the enterprise. That's why if you're out looking for an agency, please ask him from the beginning of the agency to give you a description, a history of their agency and how it grew and whether they made acquisitions. And if you're valuing your own agency for sale, perpetuation, or succession, do the same for the person who's looking to buy you. Number 2 is the economic outlook in general, the condition, whether you're in Newark, New Jersey or San Diego, California, the economic condition of the area is very important. There are some areas that are very depressed, and the economies of that area will keep the value of a business down, where exactly the same business in another geographic area would be much more lucrative. Number 3, the book value of the stock and the financial condition of the business. This is the tangible net worth of the agency. It's a calculation done off the balance sheet, and at the end of the session, I'll give you a phone number and an email address. If you call me, I'll give you the formulas. Anyone who has a balance sheet published can run their own tangible net worth and identify what the book value of the stock is.
Good.
The financial condition of the business is really important. We do a lot of work on financial analysis to make sure whether a business is profitable or not profitable, whether it's close to bankruptcy or is cash rich. It has an effect on the value of the business. The next one is the earnings capacity of the company. This is bottom line profit after tax that is potential for the agency. If it does a 5% earnings capacity, it's going to be worth less than a business that does a 15 or 20% earnings capacity, naturally. The dividend paying capacity to the owners. Has it paid dividends in the past, and does it have the ability? There are many agencies that are cash rich, have great earnings, retained earnings, and have a dividend paying capacity, and there are many more agencies that are close to zero in retained earnings and have no dividend paying capacity. Goodwill and intangible value. The intangible assets of an agency accrue to their benefit on a balance sheet, but not if the agency is sold. That doesn't go along with it. The sale of the stock and the size of the block to be valued, whether it's a minority interest, which is discounted, or a majority interest, or 100% interest that will be moved. And finally, the market price of stocks of corporations in the same or similar business. These are the comparables that you see often expressed in real estate ventures, where a house can be valued, including what the comparable values of other houses of the same size and the same age are in the same area. Well, a lot of companies that are publicly traded can do this as well because these numbers are out there. But for the insurance agency industry in general, this can't be done because, although some folks in the appraisal business try to do this, because there are no good conceptual histories of market prices of closely held businesses in the United States for the insurance business. So that's Revenue Ruling 5960. Any appraiser that you hire that doesn't know this Revenue Ruling, get away from. It's not someone that you want to use. And so with all that gibberish, the question is still, what's my agency worth? And then I'll get 15 calls a week, and they'll ask me, Al, I don't want to bother you. I don't want to take a lot of your time. What's the current value? Is it 1 time? Is it 2 times? Is it 3 times? George, my answer is always the same. Times what?
Yeah, times what?
Here are the rules of thumb that you hear about insurance valuations. First one, multiple of revenue. This is the total income of the agency times some multiple. You have multiples of commissions. Now, this is the operating income of the agency, does not include contingencies, does not include any extraneous revenues that aren't from the operation of your insurance agency. So it's basically commissions and fees. Multiple of earnings. This is really interesting because earnings are after-tax dollars left in the agency. Then we have the famous EBITDA. That's earnings before interest, taxes, depreciation, and amortization. I can go on forever about this. This was a calculation that was created specifically for the tech industry when the tech bubble burst, because the tech companies made no money but had great promise, and so the appraiser said there must be a way of describing the value of a business that loses money every year, and EBITDA was it. Now, it bears no value beyond what it says. It's earnings before interest, which you have to pay, taxes, which you have to pay, and depreciation and amortization, which are non-cash expenses. That adds to cash flow. So basically, this is a modified cash flow analysis of the agency. I call these 4 items valuation voodoo because they're easy for someone with very little knowledge to express in terms of some multiple. But the multiples which can be used can only be used on the back end, can never be used on the front end. You can never express the value of an agency by a multiple, but you can also always, once you have the value in dollars, if your agency is $1 million of income and the value that we determine is $2 million, I can tell you that your agency is worth 2 times its revenue. But I cannot go to another agency and say because George's agency was worth 2 times, so is yours, because every agency varies so significantly from another that you can't do that same kind of multiple. When they call me, I ask them the question when they're looking for a multiple, why don't you just take $10,000 times the number of chairs in the agency? It's just as good as any other way. And you know what? If the value isn't high enough, you could just move more chairs in.
Oh, that's really nice, yeah.
But yeah, I know it sounds a little strange, but realistically, I can take an agency that I'm going to sell next year, and I can increase its earnings tremendously. All I got to do is fire a couple of people. Suddenly there's a lot more money to the bottom line. Now somebody else who buys the agency is going to have to add those people back in, but it sure shows great earnings for me. If I'm going to wait to sell my agency until I get a big account. Now that big account that generates another $100,000 of commission to me may only last for a year or 2. But if you're looking at a multiple of revenue or a multiple of commissions, I'll wait until I write a big account. And I would never sell when I lose a big account because it would affect me the other way. So you can't do these valuation voodoo. And what we're going to explain
What do
now,
you do? I've always used these, but I'm
yeah, of
learning. Yeah.
course, because it's so easy. Multiples are easy to do, but they're not right. The real value of any agency is its future earnings potential
Yeah.
over a period of time under specific circumstances to the valuer
Uh-huh.
at the point in time that the valuation is being done. So you can imagine three different people valuing the same agency. The guy who's in it now, who's valuing it for his estate planning purposes, he intends to continue running it. The young guy who's in it, who wants to take over the agency and make the old guy an offer, and the guy from around the corner who has lots of capacity and a lot of space and would love to get rid of a competitor and would buy that agency, take two or three people out of that agency into his own, take the entire book of business, don't have a need for all that rent and additional expenses, doesn't need two accountants, doesn't need two lawyers, makes a lot more money. The value of that agency is going to be different for each of those people, and the value to each of those people is absolutely correct. So, how do you figure future earnings? Well, here's how to do it. You take historical trends of your income stream and your expenses, and you adjust for expected changes. And then you calculate any risk factors that might discount the value because the expectation of historical trends into the future might not happen. For instance, you might have a George Nordhaus who is a superb marketer and could do wonderful things if he had another 10 or 15 years. But at the age of, what are you, George, 110 now?
Yeah, 99.
99.
Yeah.
I don't know if you have another 10 or 20 years available
I
to
hope
you.
so, but go ahead.
So I hope so too.
You ruined my day, but that's okay.
So if you have future earnings concerns, if you're doing this for yourself, you're going to assume that you're going to live forever. But if I'm buying your business and including you in on that business, maybe I can't project that you're going to be around for 5, 10, 20 years. And I may have to discount the value of your agency for the expectation that you will retire at some point in time to that, that little island in the South Pacific and enjoy yourself for a few years. So when you do that calculation, do your historical trends, project into the future, adjust for changes, calculate your risk factors, then the next thing is you've got to determine how long you're willing to give up earnings to buy the agency. Don't fool yourself, folks. No one buys an agency with money that isn't being made from that agency over some period of time in the future.
Mm-hmm.
The money's going to come. Now, I may have to go to a bank to get the money, to borrow the money, but the payback of that money wants to come from what I'm buying. If you thought, George, that you could buy an agency for $1 million that over the next 5 or 10 years would give you $50,000 of earnings every year, would you buy the agency?
I'm not quite sure. Maybe shouldn't.
Yeah, well, you should. Well, you'd be generating $50,000 times 10 years, and you'd be spending $1 million to get it. That's a bad deal.
It's a bad deal. You're right.
If you would buy that, I have 2 bridges that hook up New Jersey and New York that I can sell you tomorrow.
I don't think so.
So when we look at historical trends of revenues, we look at every line of revenue differently. So we don't take entire revenues. We look at commissions, we look at contingency flow, and yes, if an agency has steady contingencies, whether they're high or low, but they're steady, contingencies will become a part of the value. If the agency's contingencies go from 0 to hundreds of thousands of dollars and back to 0, we may cut out contingencies and cut a separate deal with the agent for any contingency futures over the next year or 2. Life and health income, same as P&C commissions, except for the last few years, we know that life and health income has become tenuous. It's an interesting issue.
It sure is, but it's something we don't need to discuss now, but I know exactly what you're saying.
Yeah,
And
and anyone who calls me, I can explain
yeah.
why that has to be treated differently. Investment return, which is quite low now, but I remember back in Jimmy Carter's time, it was 14, 15%.
Hmm.
And fee income, which especially on the West Coast coming east is becoming an important part of income. And then you have other income, rental income, miscellaneous income. If it's on a regular basis and you're talking about providing a value for as a going concern for the existing agent, then you continue other income as well. Now we take that and we determine the historical trends of expenses as well, and we do that as finely as we can. So we don't take a one number for expenses of the agency. We separate it into compensation, executive, sales, and office. We separate it into costs of employment, which are your benefits and payroll taxes and any other costs of employment. We do sales expenses, operating expenses, and administrative expenses. Now, when ACG does valuations, we do it line by line, so we do it much more refined than this, but we've seen agents who've done very successful valuations using these composite calculations.
Okay.
Then when we make adjustments, we look at every line of revenue and expense and their trends, and we build a pro forma view of future income and expenses at least 5 years into the future. That's why I say, can you do it yourself? If you know spreadsheeting, absolutely. If you're a good financial guy, absolutely. You just have to do trending forward. And you adjust every line by anything that you know is going to happen or expect will change as the result of whatever transaction you're doing, except we never bet on the come. That means if you have a P&C agency that doesn't do life and health, and you have a vibrant life and health department, and you assume that you're going to walk in there and cross-sell every P&C client, that's a bad bet to
Hmm.
value that agency,
Hmm.
including income that it hasn't generated yet. That income would be yours if you manage it, but you never know whether that agency hadn't cut a deal years before with another life agent who's penetrated every one of their good accounts. Then the next thing you do is you go into your risk factors. And we look, the first risk factor and the only solid one is we look at the 10-year T-bill rate. Some people use 15 and 20-year. We think that the time value of money is stable enough at 10 years. It's very low now, but it fluctuates, and it's published in the New York Times and the Wall Street Journal, and it's available online every day. You look at carrier risk factors. What are the chances that the carriers are going away, either market conditions or loss ratio? So obviously we look at 3 to 5 years worth of loss ratio data on each carrier.
Hmm.
We look at the client risk factors. We look at the top 10 or top 20 clients, how long they've been there, how old they are they at risk for being acquired or retiring? We also look at staffing risk factors the same way. If you have a 75-year-old owner and you're looking to acquire that agency, look at his staff and see if they're not 75 years old as well. And they may leave at the same time the owner does, and if you're not prepared for that, that's a downside. The end result of looking at these four groupings. Now, within these four groupings, we have some 200 questions we ask
Wow.
that gives us very refined risk factors. But what we do, and this is subjective, you identify a raw rate that is discounting the earnings potential of that agency. So, how long are you willing to wait for your piece of the rock? The value to you is equal to the discounted earnings potential for as long as you're willing to wait to earn your full share of profit from the venture. For instance, if you have someone that you would eliminate your biggest competitor for, you may be willing to wait between 5 and 10 years before you're making money on that. In other words, you take the earnings potential for the next 5 to 10 years and you say to the owner, assuming that we'll make those earnings, I will pay you that amount in order to make you a part of me. But a lot of agencies that don't have the staying power for that want to see a positive return on their dollars within the first year to 3 years. And if 3 years is your outside limit, then you'll look at his earnings potential for 3 years, and that'll be the value that you can offer him. So valuation is as important as the annual checkup that you go to the doctor. Now, what this means to me is if you're not smart enough to get an annual checkup, you probably don't need a valuation either. You just assume that someday you'll die, and if you're lucky, it'll be quick, and somebody else will have to deal with all the agency, its value, and everything else. You don't have to worry about it.
Nice.
And I'm sorry, but there are people out there that are exactly like that,
Sure.
and I don't want to guilt them. They don't have to do this, but if they don't want to consider it, that's fine too. However, if you plan to live and enjoy the value of your assets someday, want to retire at some point in time or sell down and not retire, and you have $1 million asset or a $5 million asset, you want a valuation. If you don't want your spouse or family to figure out after something bad happens to you and you're taking harp lessons or pitchfork lessons,
I got it.
As the case may be.
Yep.
And if you care about your staff or your clients, then value your agency. The cost, whether you do it yourself, that's only a few $100s, or you have us or some other appraiser do it, it's not outrageous. They put a lot of time and effort, the good appraisers, into doing the valuation. And once they have all that data in their systems, revaluations are very inexpensive because you only have to add 1 year of data in order to do that. So we strongly urge you, value your agency this year. Call us if you need help, or if you need referrals to others. If you don't want to use us, that's fine too. We belong to AIMCO. We have a dozen appraisers in there who would be happy to value your agency.
AIMCO is the consultants organization.
It's the American Association of Insurance Management Consultants.
Right.
They have a very fine group of people, and unfortunately, they have me too.
I wouldn't say that, Al. I think I've just heard the most meaningful presentation of this subject in my many years. I'm so impressed with what you did here in 30 minutes. It's just a knockout. The one thing I would suggest is that the agency principals, I don't know what they do with this. Do they show other people in the agency? Should they
No, they should show their wives, their partners, their accountants, their lawyers. They're the ones who are going to be vastly interested in this.
I agree with you. And then you said that you would provide, if they give you a call, you would provide what?
Give me a call. I'll send them the calculation for tangible net worth, and I'll help them with any questions they have, no obligation.
Oh, that's so neat for you to do that. And then they can subscribe. I'll tell you what I'll do, Al. I'll put the subscription link also over on the email, because they can't get it from the slide, but they can go over there and click right on it. Pipeline, I just tell you guys, that's something that every agency should have. I've never had an agency that I recommended it to said anything but good. Al, I thank you. This is just exactly what we needed, and I'm quite sure that I feel very confident that I'm going to continue to recommend you to everybody that I know when they come up with this. And this is only one of the things you do, but we can't go into that right now. But this I think you're head and shoulders above everybody else, ahead of everybody else. How's that?
Well, thank you very much, George. I appreciate it.
I mean it. And for the rest of you, don't forget to go back. You can go to the archive. You can go to the quiz flash back on the email. We're going to expand. You should know this. We're going to expand the email, and there's going to be a lot more stuff on it in the future, in addition to going all into the Monday morning. And you should also know, and I've said this before, there are over 50,000 people now getting this each week. So, Al, maybe we'll only get 10% of those. Only 10,000 people call you. That'd be all right.
You know what? I can handle that. We've staffed up.
Okay. For the rest of you, I'll see you again next Monday morning.